Today's video, what we're going to tell you about is a magic phrase that allows business owners, mixed-use property owners, and multifamily investors to increase their cash flow by thousands and sometimes tens of thousands of dollars each and every month. And this is something that every one of those property owners can implement today. Now, what I'm talking about is a phrase in HUD insured multifamily mortgage loans and how you can make that work for you even if you currently do not have a HUD loan. So, first, a few things about HUD multifamily mortgages. The HUD 223 loan to be specific. Okay, so why the 223? Well, first, the 223 has the lowest interest rates available, has higher LTVs, a lower debt service ratio, fixed rates up to a 35-year term and up to a 35-year amortization. They're fully assumable and they're non-recourse. And those are all the things that investors want, right? Now think about it. What do you want as an investor? You want lower interest rates, you want lower debt coverage ratios, you want better terms, and you want to make more money each and every month. So let's stop beating around the bush and let's get right to how you can increase your cash flow today. So, what exactly is the magic phrase? Well, in the HUD 223 loans, there is a phrase that states for HUD multifamily properties, you are allowed to have commercial space within the property provided that the commercial space is limited to 25% of the total net rentable area income or 20% of the effective gross project income. That's it. That clause right there allows mixed use properties to be underwritten and financed and treated as multifamily properties. As we know, multifamily properties are deemed to be a much lower risk to lenders than mixed use properties. Now, typically, the industry standards look something like this. Okay. For a mixed use loan, your typical conventional everyday mixed use loan that you get from a bank maxes out 75 LTV for a rate and term refi. Okay. And 70% if you want to do a cash out refi. Now, they're always non assumable. They usually carry a 30-year term and they're full recourse. Now, when you compare that to the HUD 223, you'll see that the HUD 223 goes up to 85% LTV on the rate and term refi, up to 80% LTV for cash out. They're fully assumable, can go up to a 35-year term, and they're non-recourse. And of course, the HUD insured mortgages offer the absolute lowest interest rates that are available. Okay, so you might be wondering how in the world can I get a HUD loan if I'm a business owner or if I don't already have a HUD loan? So let's suppose you own a business and the property that you purchased to house your business has let's say your business is, let's say you own you're a dentist and you have a dentist office, and on top of that dentist office you have 8 apartments. Now it could be a pizza shop, it could be a retail store, but let's say there's 8 apartments on top. When you're dealing with these HUD mixed use loans, one component of the property must be residential units. So, like I said, you can have the pizza shop on the bottom, or a restaurant, or the doctor's office, or retail store, or whatever. But you must have residential units. You cannot have, let's say, your dentist office on the bottom and other offices on the top, or retail on the top, or retail mixed with industrial. It can't be that way. It has one of the components must always be residential units in order to qualify for this. Okay. Now, in all likelihood, if you have a mixed use property, you probably purchased that property with a conventional bank mixed use loan or some type of small business administration loan or SBA loan. Now, the sad truth is that those loan products just do not have the same attractive terms that you're going to get with the HUD 223. They just don't, and there's really nothing that you can do about it other than switch to a product that gives you the terms that you need to increase your cash flow. Now, let's suppose you have commercial space in your building and it accounts for less than the 25% of the total net rentable area income and 20% of the effective gross project income. You can refinance it to a HUD loan and you can get all the benefits that I just mentioned. And the lender will now treat you like an A credit risk as opposed to a B or C credit risk. Now, what if your property does not meet those requirements? Well, there are some ways that you can work around